Welcome to Wealth Management Mixtape, a go-anywhere show about life, finance, and investing. Join Jake Heisler and Tim Miller as they talk about what they're reading, writing, and experiencing. Jake Heisler and Tim Miller work for Quaker Wealth Management. All opinions expressed by Jake and Tim or any podcast guests are solely their own opinions and do not reflect the opinion of Quaker Wealth Management. This podcast is for informational purposes only and should not be relied upon for investment or financial planning decisions. Clients of Quaker Wealth Management may maintain positions in the securities discussed in this podcast.
I was going to ask you about the Phillies to start off. Are you a big? You're a Phillies fan, right?
Yeah, I don't even think we can talk about them at this point. I mean, they finally snapped their 5-game losing streak, but
I haven't been tuning in.
It's been brutal. I mean, it's the same thing year after year. It's just, at what point are you going to start putting money into the bullpen? So, I mean, if you're John Middleton, you can put money into, the team and all these great hitters, but when are you going to put money into what's the root of the issue, which is the pitching? One of these years they'll get it right after a decade of getting it wrong. We'll see.
The issue to me is that they don't have any farm system ever, and it creates this kind of like domino effect. But it's why it's the same thing over and over again. You can't tell me we don't have a guy in the minor league system that can come up and throw a fastball over the plate in the high 90s. Not one guy.
Yeah,
it's the same question I ask every year. Yeah,
it's our top prospect right now. I'm blanking on his name, but it's always the same story. We have a top prospect. We'll trade him away in some type of deal, and then we're right back at square one. Yeah.
There's actually a catching prospect that's supposed to be pretty good. He's been tearing it up, but he's he can't get up there because of Real Muto.
Yeah. Doesn't matter how good he is. We're giving Real Muto, what was his contract, like $100 million or something like that?
Yeah, and I saw that, I think it was like David Murphy had said that he suggested trading Real Muto and bringing the other guy up.
Well, he's been awful this year, so maybe.
Yeah, no, not much trade value anymore. So, anyway, what's happening in the world of stock markets, bond markets? The first note that I had on my screen, which was that the Fed started tapering their balance sheet this week. And that sounds really aggressive, like there's some active things going on there, but really it's just letting bonds that mature, treasuries or agency bonds, just mature and not use those proceeds to buy additional bonds. And that's how they're tapering their balance sheet. And theoretically, you'd think that not buying back additional bonds would lessen demand and would push rates higher. But we'll pop a chart up on the screen here in a second. But it actually does the opposite. So in times of tapering, bond prices or bond yields actually go down. So it's like a forward discounting mechanism. It's so contrary to how you'd think from just a general economic standpoint. But yields actually trend down, and vice versa when it's quantitative easing, they're buying bonds, and potentially lowering interest rates. Yields actually trend up over those time frames. That was really odd to me when I took a look at it.
Isn't the argument that they should have started doing this tapering a lot sooner?
Yeah, yes. I think I used a term recently for for coronavirus, like the economic fallout from coronavirus. I called it the great magnifier. It's like everything is exaggerated. Like every pendulum swing is just so extreme and through the roof that it's tough to. They have their core data set. The Fed does to how and when they taper, that sort of thing, or ease for that matter. But it's just that the economic data is so off right now that I don't know how you glean anything, important from any of it to make sound decisions moving forward if you're the Fed.
And there's really no playbook for a global pandemic. There hasn't been a pandemic in the last 100 years. So the economic fallout following that pandemic is not like, this is the step-by-step process of when the Fed should start tapering and when to raise interest rates. And there's a lot of different moving pieces that have to be timed appropriately to have the economy running at a good pace. But obviously right now we're experiencing inflation, which they deemed as transitory for a period of time, and has kind of even stepped back and said we were wrong for labeling it transitory as long as we did. So a lot of
Eventually it is
explaining to do.
transitory. eventually
Hopefully it is
transitory. And,
I mean, you see, what's the first sign of that? You see used car prices starting to roll over or peak at this point.
Yep, inventories at retail stores like Target and Walmart have gone up tremendously. Theoretically, that means potential disinflation, where you have you're overstocked. You've got to reduce the price of that stuff to get it off the shelves. So it could be lowering prices. So it's almost like, again, it goes back to the pendulum swing thing. That it swings one way, and then we've overdone it, and then it swings back the other way, and it gets overdone until eventually it evens itself back out again, and has more normal swings back and forth.
And I think because of that excess inventory of the retailers, like you mentioned, the Walmart and Target, they got hit pretty hard after reporting earnings, right? So they had, Walmart was down maybe 10, 15%, and Target was down 25%, 30%, which is, a huge, a huge swing for what are seen as more stable stocks. And then,
does anybody
you
not believe that Target and Walmart are going to be around the next 10 years? I mean, that's the other part of this whole market environment, is that there's this visceral reaction to any news. Target was trying to get ahead of the curve, Walmart too, by increasing their inventories, right? People were complaining about shelves being bare. They've gone ahead and done that, and then got crushed for it when they spent more money than they analysts thought they would spend.
Yeah. And then you have social media.
Go ahead. I'm sorry.
And then you have social media stocks coming out and reporting earnings, like a Snapchat reporting decent earnings, and then coming back 2-3 weeks later and lowering their guidance or forecast for the rest of the year based on recession fears. So the first thing that these companies are going to do when there's a fear of recession is cut, advertising dollars, research and development, and all of those different areas of a company that you can kind of trim away some of those expenses, which even in COVID we saw were the first to go when there's a fear of recession.
What I find so interesting about any of these earnings is that, let's take Snapchat, for example, is that their earnings mattered so much. This one company's earnings mattered so much in the language used by the CEO in reporting it, that it just decimated the market for that day or two, or for 5 days or whatever. But last time they reported their earnings, didn't matter at all. Like they had good earnings, and that didn't drive the market up, right? And the time before that, the earnings were bad and didn't drive the market down. So it's that's that overreaction thing going on, that we're definitely in an environment right now where people are waiting for the next piece of bad news to sell. So I don't think the selling's over yet, not to be making predictions or anything like that, but I wouldn't be surprised, I should say, if the selling's not over yet. You can still see that everyone's waiting for that one piece of bad news. And even as advisors, I'll ask you in a second, but I get the sense that when the market's up on the day, that it's probably not going to stay there by the end of the day. Today was different, but what's your sense on that? Do you ever get that sense when the futures are up in the morning? And
yeah, I would say right now, just watching where the futures are to start the day, I don't think that's a good indicator where the day is going to end up. And like just yesterday, there was a 750 point swing throughout the day from the highs and lows of the day. And that's just, hasn't even been the biggest swing in the past few months. There's been even larger swings, but just to say that there's that much of a swing throughout a trading session is, it's really something we haven't seen for quite some time.
Yeah, and volatility usually means downward price movement over time.
Mhm.
At some point that'll shift, but that fear of loss right now, even to your point, on a daily basis is pretty extreme.
Yeah. And we also see the last piece. So we said retailers and social media, but then we're looking at like venture capital firms coming out, and we have some of the biggest ones: Y Combinator, Sequoia Capital, and they're writing these doomsday kind of prepping scenarios for companies startups that they deal with, and saying you should be able to sustain yourself from a cash flow perspective for the next 12 to 24 months, and you need to cut expenses where possible. And they're just kind of setting up this backdrop for you need to be able to self-sustain without new funding for the foreseeable future.
And is that part of that pendulum swing? Like they're going way overboard and saying, be prepared for the next 2 years, 3 years. Is that too much?
Yeah, well,
we won't know until
we don't know, but
actually.
I think I was reading that the last time they did the same exact thing during COVID, and it came back a lot. It like those ad dollars and all those other expenses that they try to cut at the beginning, they came right back a lot sooner than they thought. So maybe this is seen as a little bit different than COVID, because COVID was such a swift drop and then rebounded so quickly. But inflation seems to be here to stay, and there's a lot of different factors that seem to be taking a little bit more time to kind of play out than the initial COVID drop did.
Now I got some flack on, of all places, LinkedIn, which is like usually nice people. It's not Twitter or whatever, Facebook or whatever, where it becomes a battle immediately. But I said something to the same effect, which is that these venture capital firms are starting to suggest cutting costs. And where I got some flack was that the easiest place to cut costs is labor, right? Is to lay people off. And it's not like it's not what I want it to be, obviously, but that's the side effect of a potential recessionary environment, or planning for it, is you find the fastest way to cut costs and get your feet under you, or preparing to get your feet under you. And that's just the way a capitalistic economy works. And no, it's not good for employees. But it's the reality of how our economy functions, and the free market, free market functions. And one of the pushbacks was, well, this is another way that the rich get richer and that sort of thing. And one of my comments to those folks was, look, it's at the end of the day, is that your goal, to be one of those folks? Is it your desire to be one of those? And usually the answer is no. So look, you can't control that. What you can control is being prepared, from a personal financial standpoint, on if you were to be laid off, and have a backup plan and network to look for another job. But it's the reality of kind of where we are right now. It's preparation for, it's tightening the belt right now.
I think that kind of leads into the recent article that you had, that you labeled the Retirement Scooch. Do you want to dive into that and give some background on the article?
Sure. Well, we work with clients that are retiring all the time, and so it's one of the reasons that we meet people in the first place, is they're looking for an advisor that can kind of guide them through that process. But without a doubt, there's this thing that happens in that retirement decision making process, which is for the retiree or potential retiree, there's always this kind of series of reasonings that go on, and oftentimes it leads to the retiree pushing back the retirement date. Like something's not just right, and or the market's down a little bit, and no matter the planning we've done as a lead up, and the probability and Monte Carlo simulations are all look good, it still prevents retirees from actually retiring and doing presumably what they want to be doing, which is whatever they want to do, right, with their time. And so the article that'll probably be out next week is it's just about understanding that that's a normal thought process, that there's this fear that you lose some level of control when you retire. There's no income to replenish assets if the portfolio value goes down. You've been defined by what you do for your entire working career. Now you're not doing that anymore. Usually it's the primary way you're defined. And so that changes. And so the article is more about, well, how do we find some ways, even if they're small ways, to return control to the retiree, right? So that was the kind of the genesis of why I wrote about it. I call it Retirement Scooch because it's like they keep scooching back the retirement date over and over again. And all of a sudden it's 2 or 3 years later and you're like, you could have done this 2 years ago. And
I think that people expect that they're going to work their entire career and then there's going to be this perfect scenario where they're ready to retire, the market's doing well, their family's in a good place financially. There's never really that one perfect time. And maybe sometimes it just all aligns and it works out that it feels good and comfortable to retire. But if you do the prep work, you understand, what your expenses are, what your income needs are, all the different planning things that we go through with our clients, then you should just retire based off of lifestyle, like health, different things like that. If you run the numbers and you run the different simulations, you should know that there's going to come a point where working becomes optional. If you choose to work past that date, that's fine. Should it make you feel comfortable, by all means, go back and work part-time, but that you don't have to work any longer should you choose not to.
Yeah, and that's the difficult thing is the unpleasant feeling that brings that the market, some external force, can somehow impact your current lifestyle. But you're right, the planning that is done properly in the front end, you should be in a place where that's not the case. And the 2 points that I kind of brought up to bring some control back was, one was around Social Security and when to take it. And then the second one was having more of a dynamic distribution strategy in retirement that takes into account those fears you have, which is the market pulling back, and gives you a way to move or pull the strings a little bit, either ratcheting back distributions or ratcheting them up. There's a positive to that as well. And the Social Security side is one that I'm not sure a lot of folks know about, but assuming you haven't collected Social Security yet, you haven't made that selection yet, and you're past full retirement age, which is, I think right now is 66 and 10 months, I believe. Might be off on that. But if those two things are true, then, and let's say you're 68 years old and you retire, or you just retired, and the market pulls back, right? And you're worried. I just retired. I don't have any income to replace my assets anymore, and I'm worried. But there's this rule in Social Security where you can go 6 months backwards and get a lump sum payment for those 6 months worth of Social Security payments. And in essence, replenish your cash reserves and give you some more breathing room for those retirement expenses that you were just worried about, 10 minutes ago. The only caveat to that is that it's your future monthly income is as if you had filed for Social Security 6 months ago, and it can't be any longer than 6 months. So it's a way of giving yourself some breathing room, or the option for breathing room for one of the major fears, which is, oh my gosh, I just retired and the market went down. So it gets you to kind of replenish your cash position without having to actually dip into investable assets.
I think one of the biggest fears for folks is adjusting to the fact that they're paying themselves from their investments or from their savings, and they can't replenish those investments or savings through income. So just mentally making that switch from having a paycheck coming in to paying yourself from investments is definitely a huge leap for a lot of folks.
Yeah, and you play the what if game so many times that you scare yourself. You start the retirement scooch. That's what happens. We should make a dance out of the retirement scooch, Tim.
Not me, maybe you.
Well, everybody in the office. They'll love it. And the second point I made was you don't have to look. We do with all our clients. We figure out, okay, what's your annual expense need, all in, hobbies, mortgage, taxes, gifts to grandkids, whatever else, your entire year. So that's the starting point. It's good to have those numbers down. So you get a monthly number out of that. Let's say it's $120,000 a year. I'm just using a round number because the monthly number is $10,000. And every month you take $10,000 from your assets. But what if the market goes down? Let's say we're in coronavirus, right? And we're sitting pretty in February, and in March, assets have dropped. The S&P has dropped 35%, right? You're freaking out. Well, dynamic strategy doesn't keep those payments the same. So 10,000, 10,000, 10,000, 10,000 over and over again. It scales down, not necessarily based on the market performance, but your portfolio's impact on your probability of success, right? So if your starting point was there's an 85% probability of success that you have assets at the age of 100, which, by the way, is a very good probability. We're always pleased to see 85%. But that 1 month drop, that substantial drop, that was kind of a one-off scenario, coronavirus in this case, moves you down to 75% all of a sudden, or 80%, right? We would suggest in a dynamic strategy that maybe you ratchet back your distribution for that month or the following month. So down to 9,000 or 8,000. And the same holds true on the upside, that if there's been outperformance and your portfolio value is higher and therefore your probability of success went from 85 to 90%, you should now, or you could now, take out $11,000 or $12,000 a month. So it works from a lifestyle perspective in both ways, but it just makes you conscious of when might be a good time to pull the lever back a little bit and when a good time is to ratchet things up. And, one of our primary goals of our clients in retirement is usually traveling, right? And so maybe the year in which probability of success has gone up substantially, maybe like a year like last year when the markets rallied and portfolio values are up, that 2022 would have been a good year to schedule a big trip, set aside some cash from the earnings from last year. Your probability of success went up, therefore your distributions could be higher in the beginning of the year, and so on and so forth. So for us, and I think for individual investors, is taking that control that you think you don't have, applying one of your major fears, the market drops and your portfolio balance goes down, and adjusting based on that fear. So it puts kind of the control back into your pocket a little bit.
I think the only thing to point out from that strategy is people would automatically think, well, I don't want to have to think about what the market's doing month to month. And it's really that it's not a month to month type of dynamic strategy. It's more saying in certain events like COVID, maybe some of the months early here, it's not every month, but it might be once a year, once every other year, once every 5 years that we're talking about ratcheting back those expenses. It's much more, I guess, drawn out as far as the frequency of these events actually happening. So
yeah, I
hear that.
I went back, so we'll put a chart up here. But I went back over the last 5 years, and there were 2 times. I'll let you try to guess. There were 2 times when this would have shown a good time to reduce your distributions. Any guess? So only 2 months, by the way. It's 2 months out of 5 years.
I'm going to guess March of 2020. Yeah, I'm going to guess December of 2018.
You got it. Those are the 2. So to your point, it has to be a really dramatic fall off that would cause that type of situation. It's not a month where the market's down, 2-3%, right, which is totally normal. And then the other way, what was interesting and what I found was the flex, the dynamic distributions on the upside were much more frequent. And it goes back to the point we always make, which is the market, more times than not, is up. So 4 out of every 5 years, the market is up. And so it wasn't surprising after I looked at it with some perspective that those numbers of a higher distribution far outnumber those of a lower distribution.
You want to go into the uncertainty principle? It seems like a good time in the stock market to talk about uncertainty.
Right. We talk about some version of this usually probably in every podcast. This struck me, and it's I don't know if it's called the uncertainty principle, but that's what we named it here. That in the ebbs and flows of life, we believe we've got a better handle on what comes next, or we believe it's so uncertain what comes next that, why even bother with making any changes, that sort of thing. And usually it's some version of those two extremes. But the reality is uncertainty is always factual. The future is always uncertain. There is no way to predict the future, right? And so, it's only really our perception of that uncertainty that changes. And look, I think anything from a human psychology standpoint, as it pertains to investing or anything else, I think not that you can check yourself every time this happens, but at least knowing that can give you some sense of maybe calm. That, look, we think things are great now; they're not always going to be great, right? That feeling's not going to last forever, and we think things are awful now, and that they're going to be awful forever, but they're not going to be. Right? To at least know that and kind of check yourself, I think is an important thing.
Yeah, I thought it was interesting.
I was going to ask you how many times, that goes back to retirement and to investment management, and we see it as soon as the market drops. There's this uncertainty that the world's ending, and that people want to sell out of their investments. And it's the same uncertainty existed 6 months ago, and 6 months before that, and 6 months before that. Just you weren't cognitive of it at that point because things were better. And so it's this, to me, these principles are good to know so that you don't overreact in the moment that you want to.
I think it's interesting with investing because you also point out when we're talking about the uncertainty principle that on the flip side, right now, things are not going as well. There's fear of recession, inflation, rising interest rates, Russia, Ukraine. There's a million things out there. Like you said in the beginning of the episode, is like the reaction to Snapchat showing that there was people out there just looking for a reason to sell. Like they were just looking for any bad news. And that really speaks to how fragile the stock market is, that any piece of bad news just the stock market was down for 4 or 5 days because of some bad news that generally wouldn't do that much to the stock market, but obviously it has a huge impact. But I think on the flip side, what I wanted to say was, although it says, things are so bad right now, what's the point in even, trying to make a change? Or, sometimes we have people calling in or, other investors we talk to who are talking about moving to cash. But it's really that when things are going well, people are blissfully unaware of the uncertainty ahead. And they say, well, let's get a little more aggressive. And they start to get a little more greedy with how they do certain things as far as investing is related. So I think there's two sides of it. We see both of it. Part of our job is being a psychologist and trying to tell people through the good times and the bad times, there's always uncertainty, there's always risk. And I think that kind of comes back to why we have risk tolerance levels for our different clients. So knowing and understanding your risk tolerance is number one. And then trying to navigate the ebbs and flows of the market is, always going to be there, and something that we always try to navigate as advisors.
Yeah. And there's also, that was a really good point. The tie-in to investments, or to the investment management side of things is where this all resides for us. Actually there was a good, Bill Clinton gave a speech back in 2000, right? And he was touting economic prosperity and the fact that there was the violence was down both domestically and fear of attack or geopolitical risk was minimal at that point in time. And everything he said was factually true, but that preceded the dot-com bubble and 9/11. And so it's just one of the just one point to point out, and it happens all the time. That's not political in any way, but when things feel really good, it doesn't mean they're going to always be good, and vice versa. And look, with the stock market, this is one of the points I wanted to make. Well, I was meandering back there for a second, but was that what drives markets is this fear, and these fluctuations up and down, right? Fear of loss, market goes down. Fear of missing out, market goes up. They have to happen, and they have to happen to have any outsized returns over time. If the market was always flat, I wrote something about this years ago, but the market was always flat, right? There's minimal volatility, then the returns would be nearly zero. They'd be like cash, right? Because then it's almost as safe as an asset class as cash. So why would I risk, but the volatility is the reason there's outsized returns in the stocks. It's just that the question is, can you manage your own expectations and your fears as you're going through it? I know we talked about that before, but I thought there's a tie in there. And sort of relating to retirement, one of the things we wanted to touch on was that there's more and more information out there now that demographics are there's an aging problem going on here, where the average age in most countries at this point, year to year, the average populace age is getting higher, meaning there's not enough younger folks to offset the age of older folks. And so that average age keeps moving up and up and up year after year. And it's a problem for a couple of different reasons. One is from a healthcare cost perspective, right? Supporting folks that are disproportionately a larger segment of the population. So from a cost standpoint, but also replacing their productivity is really important. So if you've got a population that's aging and therefore more folks are retiring, their productivity has to be replaced by a younger population or younger part of the population. But it has to be equally as productive for the economy to roll forward as usual. So either the aging folks have to work longer, younger folks have to be super productive, which is probably not going to happen. Not taking any stance against any generations or anything like that. It just wouldn't happen because it hasn't happened ever that way. Or technology's got to advance to a point that replaces that productivity in some meaningful way, right? There's a trickle-down effect to all of this stuff from an economic standpoint and a market standpoint and a planning standpoint that we as advisors, I know, are going to be facing as the years progress here.
And what do you think some of those different challenges are going to be? Like, are they going to push back the age of full retirement age for Social Security? We've already seen companies move away from pensions. A lot of these publicly funded programs that are now going to be funded by the younger population, trying to offset that aging population, which you just discussed, which is becoming a larger percentage of several countries. I think the stat you had was over 20% of the population in 17 countries consists of people age 65 or older. So, and that number is only increasing year over year. Yep. So now you have this aging population where people are living longer, and the younger generation not only has to replace that productivity, but they also, from a cost perspective, have to offset the rising cost of those publicly funded programs, which I think is a a huge challenge.
We'll put you in charge of making new policy, right? What would you do for the Social Security? Because that's on everybody's mind. And we hear it every once in a while from folks that, what's the chance of my Social Security getting cut? So if I put your policymaker, you've got full reign on Social Security law, what would you do?
Yeah, I don't think you'd want to be the one to cut Social Security benefits or do away with Social Security altogether, which is what we hear. At some point, this might not be a thing in my lifetime anymore that I'm receiving Social Security. But as a policymaker, I don't think you would get a lot of votes if you were trying to to promote cutting Social Security benefits, which retirees are. A lot of retirees are dependent on that stream of income month after month.
Yeah, Tim wouldn't get reelected. That's what you're saying if you did that.
I wouldn't get
that's
very
true.
far.
Totally true. I could definitely see to your initial point that for our generations, right? You're younger than I am, but definitely for your generation, that full retirement age, they've already obviously done that. They get scaled back as you for younger and younger folks. So instead of 66 and 10 months, it becomes 67 and 67 and 6 months, et cetera. So I think it's a combination of that, pushing that back, not cutting Social Security, pushing that back, and then even maybe moving that other checkpoint back, which is the latest age you can wait to take it, which is now 70. So that gap is getting shorter and shorter between your full retirement age and age 70. They could widen that back out again, and then push everything back, for younger folks.
Do you think that just by pushing back the age of Social Security, like that initial filing age, then the full retirement age, and then the capped age where it stops accruing or growing, don't you think that would naturally push back the retirement age of thousands and thousands and millions of people?
Yeah, I think it has to do with how healthy people are. It's one thing to live a long life, but it's another thing to live a long, healthy life. And so if the population's healthier, yeah, I could definitely see that affecting the average retirement age.
Yeah. I mean, but like, how many folks do we run into that come up and have the same kind of timeline for retirement because it's based on when they can collect Social Security? So just naturally by moving that time back, you're just in the mind of retirees, we're talking about that hesitation or that retirement scooch, whatever you want to call it. They're going to say, well, if the filing age is now 62 for those folks who want to take it the earliest they can get it, and that goes to 64, they're going to, instead of targeting 62, they're going to start targeting 64. And it's just naturally going to keep the older labor force around for a few more years.
And that would solve part of that problem. Of folks retiring and having to make up that productivity. Well, that's it. We should put it into law. We'll write our congressman.
I don't think we'd get very far.
They have to do it for a generation that doesn't vote. They'd have to do it for like my kids or something. And say, okay, for those folks that don't have a vote right now, you don't get Social Security until you're 85 or whatever. I also found interesting that when I was looking at this, there's a lot of information around aging demographics, but one thing I found interesting was there's now, we talk about crypto a lot in the office, right? Or on this podcast. That's my congressman calling me right now. My phone's ringing. Silence. But there's some decentralized blockchain-based companies that are working on aging-based pharmaceutical interventions, let's call it, right? In essence, to make people live longer, but a little bit in the opposite way that typical pharma does it now, which is they're working on kind of biomechanically helping people reduce their actual body age rather than their biological age, right? So if I'm 43 years old, that my whatever identifiers are using, telomeres or whatever it is actually 32 years old or 33 years old, right? And that would solve a big problem. If somebody that's 62 really has the body composition and health factors of a 52-year-old, well, they could theoretically work a lot longer, right? And that so they're working. There's these companies called VitaDAO, which is one, which is funding these projects through in a decentralized way and voting that way using ownership and intellectual property and a variety of other things. But for me, I think there's going to be this turn, whether it's crypto based or blockchain based or not, towards and more of a kind of a ground up approach, right? And what I mean by that is not big pharmaceutical companies getting involved, but of trying to figure out how can we make people healthier today, and not just like typical pharma trying to create a pill that solves a disease that's already in the body or something like that.
Yeah, I think it's when I was reading about, was it VitaDAO? I think it was interesting because it reminded me of, it's just a culmination of almost like freelancers coming together in this decentralized platform and all bringing and sharing their different experiences. There's no hierarchy in the VitaDAO, and they're all just kind of contributing. They're all just basically a bunch of contributors that come in and different levels of expertise, and they want to come and share and be a part of something bigger than just what you're saying is a big pharma company as we see it today. So it's this shift from big pharma to these decentralized communities of folks that want to do something that's a little bit different than is kind of breaking the traditional way of doing things. And I think it was interesting because, I don't know how long this has been around or, how long they've been doing stuff like this. Maybe, but it reminded me of what we saw through COVID, which, the first time in my lifetime I can ever remember big pharma companies teaming up and sharing research and different information, because most of the time these pharmaceutical companies are worried about their intellectual property and their bottom line. And it's, this company is focused on their research and they're not going to share that with any other companies. But you saw this sharing of research and information between companies, not only in the US, but all across the globe. And if I had to guess, I don't know if this is a fact or not, but just from my perspective, if I had to guess, COVID, finding a vaccine for COVID was one of the largest shared global research projects in human history, or at least in the last 100 years. So I found that very intriguing that this community of researchers are already coming together to kind of break the traditional way of doing things.
Yeah, and imagine if that effort was towards something like this, like making people's, younger than their biological age, how much progress they'd make in doing that.
I guess that's what their mission is, right?
Yeah, that's what they're trying to do. There's this, I'll call him futurist, Ray Kurzweil. I think he's employed by Google or Alphabet, but who kind of makes predictions based on rapidly increasing technology, kind of exponential technology increases. And he has just some wild predictions, and I'm kind of going off a tangent, but it has to do with that aging thing, that people will live some ungodly age if they're born, 10, 20 years from now, 150 years old, something like that. And that will be able to ultimately, through biomedicine, send, in essence, nano robots in. It sounds so science fiction, but a lot of the other stuff he said has come to fruition, has actually happened. He started this back, I think, in the 80s, 70s, maybe. But in essence, pharmaceutical bots that go in and solve your issue internally because they're programmed that way. In instance, AI-driven biopharmaceutical, robots or whatever, but so minusculely small that you couldn't see it with the naked eye, that sort of thing. We should cover that in a separate episode because it's just fascinating, the predictions he makes. We could do a whole thing just on his predictions and how not ridiculous, but how wild they are based on where we are today.
And does he think that's going to happen in our lifetime or?
Yeah. And I'm not even like that far out, 15, 20 years,
Yeah. Interesting.
I think he said that if a person wants to live forever, will have the capabilities of doing that in the next 100 years.
It's
So
wild.
I'm out on that, but maybe you're around for that.
I don't think I want to be around for that either.
It's a whole other.
Once I get to a certain age, it comes a point where.
What if you feel like you're 20?
I mean, do you really feel like you're 20 at 95 years old? Probably not.
I won't. I don't feel 20 now.
I got to get you back
feel
out on the
30
golf
now.
course first. Yeah.
All right.
Time for pop chart.
Pop chart. Oh yeah, let's do it.
So your beer, I'll let you introduce it.
Yeah. Well, I looked at this beer and I said, this has got Tim Miller written all over it.
I don't know if that's a good or bad thing at this point.
Well, it's very fruit forward.
Did I ever say I like fruit beer?
Well, you don't like that hoppy, that dry taste, right? That's what I've gathered from you. So it has a pleasantly smooth finish, it says. But anyway, it's and it's local. So it's brewed in Toms River, New Jersey. It's Toms River Forbidden Fruit. And it's ale brewed with apricot and natural apricot flavor. I don't know what that means, how they're separated like that. Lower alcohol, which is good, I think. This is probably a pretty good summer beer, having not tasted it yet. Now, just as a reminder, we have a scale from 1 to 10. Higher the better. Tim only gives out 8s. So that should be a good thing for Toms River Brewing.
I got a 7. I got a 7-1 in there, don't I?
The big question is, have you learned to pour a beer yet?
The answer is yes. I can
All
show
right.
you. First one.
Wow, look at that.
Yeah, first one.
It's a proud moment for.
I made a conscious effort. It's even better than yours this week.
Yeah, it is. That's good. All right.
All right.
I'll taste it first. We'll both taste it. So this would go on like a summer beer list, right? This is good to have on the beach. Definitely fruity, right?
Yeah, you go first.
We need our report card for the other beers we've done.
Yeah, we need to put that together.
I'm totally off at this point of what I've given what beer, but it wouldn't be up there with Tonwood Tipper. That's still my highest rated beer. I'm going to go 7.7. I think it's really good. It's a perfect beach beer.
So I don't know if it's you that is causing my reaction with saying I only give out 8s, or if I actually just am not crazy about fruity beers like you think I am. I'm going to give it a 6.2.
Whoa.
6.2.
This is history in a different way. Well, thank God they're not a local beer company that's gonna, right
come
down
to the
road from
office.
us about 45 minutes away. So, we'll give them your address, Tim. That's all right. The first office on the right when you walk in.
Toms River, was that like the town that had like the Little League World Series team?
Yeah, it was that town. They
What
always
was
had a good one.
Was it Todd Frazier? Is that it? Is he from Toms River? Didn't he play for them?
I don't know. There's probably
the third baseman. I don't know. Maybe I've got that completely wrong. We should have like after every episode like a fact checker of anything that we say, and then we'll start off the next episode by correcting our mistakes.
That might be an entire episode.
Yeah, we could make it like every 4th episode. Just talk about all our mistakes from the prior episodes.
baseball. I'm looking it up. Professional MLB players, right?
Is it Todd
Let's see.
Frazier? I know he was third base for the Reds and the Mets.
Close. Jeff Frazier. Oh, no, hold on. There's two Fraziers.
Yeah, Todd.
Both Jeff Frazier and Todd Frazier. Look at that.
Played for Tom's River.
Yeah.
Look at that.
Both in the pros, right? No.
Todd's the third baseman.
Jeff Frazier had a cup of coffee, and Todd Frazier played for 11 years.
Still that.
No, he's not playing anymore.
This podcast is not only financial updates, it's also
local sports legends. Next up, Mike Trout.
He'll be in Philadelphia. Aren't the Phillies playing the Angels?
Uh-oh. I just saw an article on this guy. Toms River, New Jersey native has brutal first Major League Baseball start for the New York Mets. Well, at least it's the Mets. You know?
Probably an old article. Todd Frazier?
Yeah. No, it was May 25th, 2022.
Oh, really?
That wasn't against us. Because they swept us, right? The Phillies?
Yeah. Not great. I think we should talk just for a second about what happened between Tommy Pham and Jock Peterson. Did you see that?
The slap?
And so he
I
slapped
didn't really follow it, honestly.
over fantasy baseball, or sorry, fantasy football. So Tommy Pham was upset at Jock Peterson storing it should be outlined in the league rules, but if you have an injury reserve spot and he was storing players who are correctly designated with an injury to the injury reserve spot and then picking up, because what it does, it opens up a roster spot either for your bench or your active roster.
Sure.
I'm assuming that they're throwing around a little bit more money than my league, right, as professional baseball players. But right. Mike Trout is the commissioner, and not only did Tommy Pham smack Jock Peterson for what he did, but also on social media called out Mike Trout as the worst commissioner in fantasy sports. So this reaction after that is Mike Trout coming out saying he doesn't know if he'll remain as commissioner. Can you imagine?
Oh man!
I mean, we give I don't know in our league. Yeah, in our fantasy football league, we're pretty serious about it too, and we give our commissioner, a tough time. But to get called out as a professional, like one of the best professional baseball players, that's it's quite a
calls for his resignation
from a fantasy perspective. Yeah.
Oh man, even professional athletes that make millions of dollars complain about just silly stuff. So anyway, all right.
It was also refreshing to see. It's also refreshing to see Tom Brady shank a couple golf balls the other day. He's just
even the pros shank them every once in a while. So
yeah.
All right, good stuff.